hello. How are you doing today? I hope you're having a good day so far. So, today we're talking about the principles of double entry. If you are new here, kindly hit the subscribe button, share this video to every and anyone you know that will benefit from it. And don't forget to hit the like button as well. And then turn on your notification bell so that you can get updates of my new videos. So today we'll be talking about principles of double entry, and this is a very crucial topic because it is like the foundation of accounting. Basically, if you're very poor when it comes to applying double entry principles, accounting will be a tug of war. So in this video, we're going to be breaking it down. I'm going to be explaining to you what double entry is, basic things that you need to know, and then basically, like I said, synopsis of I can write. So I'm giving you the summary of everything you need to know about double entry, and I believe and I pray that at the end of this video, you would be able to apply any double entry principle everywhere you go, basically. So without much ado, let's look at the outline for today's class. So the outline, we're going to be talking about the introduction of double entry, the story, how it came about, the principle, the debit and credit, then the tricks and the practical examples. Please, if you haven't gotten a pen and a piece of paper, please do that now because this is a class. This is not a movie that you watch and you relax. This is a class, actually, right? So let's go down into the video. So the first thing is the introduction. Now, it's very important. Like I said earlier, double entry is basically the foundation of accounting. So if you are poor in double entry, it's going to affect you a lot, and you are going to be a frustrated accountant. But that's not going to happen because here, this video is here for you, right? So now every accountant must have deep knowledge, not just any kind of knowledge, but deep. Like your knowledge of double entry must be deep rooted because that's what you'll basically be working with all the days of your accounting life, basically. So because double entry is basically, like I said, the foundation of accounting. I think I said this earlier. Double entry is the foundation of accounting. That's why it's very important that we know it. So we will just focus on major tips, like I said here, major things that you need to know, the summary, the synopsis that you need to know in this video. So how did it come about? So there was a man called Luca Pacioli, and he's regarded as the father of modern accounting. So what did he do? Now you can see this number one here, right? This book. There was a book he wrote, and a chapter in the book he published. The book he published basically was about like the summary of arithmetic, geometry, proportionality, and in the book there was a section in the book, a chapter in the book where he actually talked about double entry principle. And this was the first time that somebody actually sat down, talked about double entry principle, broke it down. Accounting has been existing since time immemorial, like since like years ago. But then Luca Pacioli actually broke it down, and then explained it to us. So with his writings, with the chapter of this book, we're able to understand double entry principle properly. And this was like people were able to study it deeper, people were able to understand it deeper, and then here we are today. We are built on his writings, and there are much more new standards, new adoptions that have been brought about to actually ensure that we actually go deeper in this double entry. So the whole double entry started from Luca Pacioli. That's the father who is regarded as the father of modern accounting. So Luca Pacioli is the one that started it all. And like I said, from his book. So let's look at it. So like I said, accounting has existed for many years. It has been existing for like a long time. But then double entry all started when Luca Pacioli published the book Summa the Arithmetica Geometria Proportioni e Proportionalita. So which means summary of arithmetic, geometry, proportions, and proportionality. So basically, it's just like it's just like a mathematical book, basically. Like you understand, like a mathematical book. But then, like I said, a section was dedicated to. So this book was published in the year 1494. In the year 1494, that was when he published this book. So since that time, that's centuries ago, right? Like it's been a long time. So since that time, there have actually been updates, developments in double entry, basically. So Luca Pacioli is regarded as father of accounting because he was the first to publish detailed writings. Like I said earlier, accounting has been existent since time immemorial. Luca Pacioli was not the one that started accounting. No, Accounting has always been existing, but then he was the first person to publish detailed writings in a chapter of his book. So it was a part of just like a chapter. It's not as if he even sat down and wrote the book. The title of the book is double entry. No, it was just like a section of the book that he wrote, and he explained how it worked, like how the double entry works and all of that. And then he made it easier to study accounting and double entry. So because of Luca Pacioli, we can easily study accounting, we can easily study double entry, we can easily understand what it means to debit an item and what it means to credit an item based on his writings. And that's why he said that he laid the foundation for modern accounting principles. So he was one that laid the foundation for modern accounting principles. Now, after this, like I said earlier, the people did not just stop there. 1494, that's when they actually published it. People didn't stop there. They actually developed it. So after this, more emphasis was laid on capital, profit, assets, liabilities. People were laying emphasis, oh, how do we actually understand what capital is? How do we understand what profit is? What is assets? What is liabilities? All these basic terminologies. People were actually laying emphasis on it. And then furthermore, standards like principles and standards such as like the gap, generally accepted accounting principles, which we'll be talking about in our subsequent classes. We're talking about it, the IFRS standards, all of that were actually developed. And even auditing, there was even more emphasis on auditing. So, but it all started from Luca Pacioli in 1494 rather. It all started from his book. So since that time, a lot of emphasis has been laid in different aspects of accounting, a lot of developments has come about. So he was one actually started the entry principle. And some students actually say, oh, he was the beginning of our problems. But really, accounting is a sweet, very, very sweet and interesting course or field of study basically. So he actually made it easier for us. That's just basically the summary of the story of how double entry started. So now, what is double entry principle? That's what we're here to talk about, right? So I just basically laid the foundation so that you understand where we're coming from. So what is the principle? Now the principle states that for every debit entry, there must be a corresponding credit entry and vice versa. For every debit entry, there must be a corresponding credit entry and vice versa. Probably we should put this in red because this is like the major thing. Let's put it in red so that no red is like, oh, let's put it in red so that we'll know how much this is very, very important. Now, for every debit entry, there must be a corresponding credit entry. That's why you say that your account definitely will balance because in accounting, we have two sides of an account. We have the debit side, we have the credit side. And I'm going to be explaining very, very soon what credit means, what debit means. But let's just say it. Now, imagine a cross. You understand? A cross or a T, like a T. Let's just use a T, like a capital letter T or something. You have the left side of the T, you have the right side of the T. So what double entry principle is stating is that for every item you put on the left side of the T or the left side of the cross, you must also be on the right side of the cross. So if you are putting 5 on the left side, you are putting 5 naira on the right side. Obviously, if it equals to 5 naira, this one will not be 3 naira, this one will not be 2 naira. No, both sides will be equals to 5 naira. So that's what double entry principle is stating is that, oh, we have to enter every entry, every transaction twice. Now, the name double entry was not, oh, what can we use triple entry? Oh, can we use one entry? Double. That name seems nice. So, no, that's not how they brought about the name. Oh. Double entry, by just as the name sounds, double means two, right? So, every transaction must be entered twice. It must be entered 2 times, double times. I don't know if there's something like that. Double. You understand? So basically, that's what it's about. So the principle of double entry is saying that you must enter every entry twice. That's double. So why is it twice? On the credit side and on the debit side. That's on the left hand side and on the right hand side. Now we have said it now. We're imagining a T format. We have imagined a T now. So let's just have something like that. So let's see. Okay, yeah, good. So we have a T, right? Let's see. A T. This is a T, right? Yes. So this is your debit. This is your debit, and this is your credit. So now what it's just saying basically is that for every debit entry, every debit entry, there must be a credit entry. Now, this is your T, right? So you have the debit side, you have the credit side, right? You have the debit side, you have the credit side. So for every entry you enter on the debit side, you must also enter it on the credit side. So if I put 5, now the debit side is your left hand side. Your left hand side is your debit side. Your right hand side is your credit side. Now, I'll be explaining this thing shortly. But let me just say something here. Let me just say something here. Now, when you want to give somebody something, what do you like the elderly people say you respect the person by what? Giving the person something with your right hand, right? No, elderly people will say if you give an elderly person probably something, they say, oh, go and bring something for me, I'll give it them with the left hand. They'll be like, oh, you're disrespectful, right? So now I'm just bringing an analogy so you can understand. So they'll say, tell you that you should use what? You should use your right hand to give the elderly person whatever he or she is asking for or demanding for, right? So now the credit side, which is the right hand side of your account, is for outflows. It's for what you give. So if you can't remember, just remember, oh, when I want to give an elderly person, which of the hands or which is it the left hand or the right hand I use? Oh, I use my right hand. So looking at it now, you're facing your paper, you're facing your book, just like now we have this on our screen, and you're facing it now. Now, the right hand side is for outflows. What you are any item that is going out. Oh, cash is going out, money is going out, all of that's going out. So that is what you have on the credit side. But on the debit side, it's for inflows. Do you understand? So the debit side, which is the left hand side, is for inflows, and the credit side, which is the right hand side, is for outflows. So anything you any just like the law of nature, basically, whatever is going coming in is going out. Or you collect your salary today with your debit side, you collect it with your left hand, right? You collect your salary today. That salary you will still spend it, you still spend it on feeding, you still spend it on other things of life, right? So it's going out. So just like the circle, it's just like a circle. So whatever goes around comes around, right? So whatever comes in goes out. So the ideology behind double entry principle is that whatever is on the debit side will also be on the credit side. Whatever is coming in would also go out. Basically, that's just the simple ideology of the principle. So that's what the principle says. So in summary, your account will definitely balance. Yes, like I said, your account will balance because you have both items on each side. You have both items on each side, so your account will definitely balance. So it's just how you arrange it. So just know that every transaction must be entered twice because it's double. Double means what? Twice. So that's just basically what they're just saying there. Now, debit and credit. Now, to explain this in further, because now I'm creating this video. This is a foundational video because I understand that not everybody has the foundation of accounting, but I want to be able to understand basic principles even after watching this video. Even if you have never heard of accounting in your life, this is your first time coming in contact with anything accounting. At least when you watch this video, you should be able to understand what it's talking about. So that's just basically it. So I'm going to be explaining what the debit and credit means. So what debit and credit means. So I'm going to be breaking it down. Now the account, like I said, your account has two sides, right? Your account has two sides, just like we drew here. Let's just use another color, right? Yeah, good. So we have two sides, which is the debit side and the credit side. Now, usually there's usually confusion as to what debit and credit is. Oh, what is debit? What is credit? I think I've explained a little from the analogy I said. Oh, you give an elderly person something with your right hand, so you credit outflows, and your credit is on what? Your credit is on the left hand side. Your credit is on the left hand side, so you credit outflows. You credit outflows, and what you debit inflows. So, in simple terms, you visualize this transaction. You understand? So, just visualize it. So, okay, now received cash of you receive, or let's say received cash of 50 naira or something like that. I don't know if you get it. So just so when you have items, when you have accounting items, just visualize it. Oh, in this transaction, what is going in? In this transaction, what is going out? So basically, that's just the way what is coming in, what is going out. So that's just basically how you do it, and then you'll be able to be good to go. Now, like I said earlier, you debit the inflows, the receipts, the items coming in, and you credit the outflows. You understand? The payments. Oh, you are paying money, or you received your salary of 1 million naira, but you are paying rent of 300,000. So now, what are you doing now? You are debiting the inflow, which is the salary, and you are crediting the outflow, which is the rent. Do you understand? So what it means is that if you are giving, sorry, if you are receiving, then record it on the debit side. If you are receiving, if you are receiving, record it on the debit side. Yes, the debit side. But if you are giving, record it on the what? On the debit, on the credit side. So receiving goes to debit, receiving is debit, and then giving is what? Giving is credit. So that's just basically what it's about. So let's use another color for this. Yes. So receiving is credit and giving is receiving is debit. Sorry, let's take that all over again. Receiving is debited. Giving is credited. Inflow, receipt coming in is what? Debited. Outflows, payments going out is what? It is what? It is credited. Now we actually understand what debit side means, what credit side means. Oh, we should debit inflows, receipts, come any item coming in, and then we should credit out items going out. Just like I said, oh, the right hand side is for what you give your elders with. I don't know, it's just like something if you forget. Oh, just know that left hand side is the debit and credit side is for the right hand side. So now, how do we know what items or what transactions to credit? How do we know what to credit, debit? And so this trick, I actually brought up some tricks. I'm going to be using this trick in this video. Now, there are so many mnemonics out there, so many acronyms out there that people have used to actually talk about what's debit, what's credit, the easy ways, and all that. But for this particular video, we'll be sticking to this particular trick for this particular video, I'm sticking to this particular trick. So, like I said, now let's now go to it now. So the debit side, you debit the what? The date. DADE, the date. Debit date. And credit please. Debit date and credit please. So you have something like, okay, let's have this down here. All right. So debit, okay, let me just go down with, yeah, yeah, yeah. Okay. So we have debit date and credit please. Let's have that in caps. Debit date please. Date please. So debit date, credit please. So now the date is what? Stands for what? D for drawings. So now any drawings, now what's drawings? I'll be talking about all these things little by little. I'll break it down as we go. So debit what's your drawings, assets, debtors. Debtors is the new name for debtors is now trade receivables. That's the name for debtors and your expenses as well. And then you credit what is going out. Creditors, that's your suppliers, liabilities, incomes, equity, and sales, which is now called revenue. So all of these things, we're going to be breaking them down one after the other, one after the other. So this is debit, one after the other. I'm going to be breaking them down. So now I'm going to first of all be looking at the credit side. Be looking at the credit side first of all. So the debit side rather, the debit side first of all. So let's have it now. So debit side. So we said that the first is what? Debit dates rather, debit date. So what is the first D? The first D is what? Drawings. Now what is drawings? Now drawings is basically, oh, I start a business. I start a baking business. Let's say baking business, and I put 1 million naira into the business as capital. Capital is the money that I used to start the business, right? So let's say, oh, this 1 million naira, I want to buy something, or I want to probably pay my rent of 300,000 naira. And I said, oh, out of this 1 million naira I put as capital, I want to take out 300,000 naira. I want to draw. So now think of it like a well of water, like a well filled with water. So what do? You have water already in the well, but then you use what? Your fetching pail or your fetching bowl to what? To draw out water. So you are drawing out water. So you're taking out cash from the company. So what? Cash is going out. Do you understand? Like now, in that using that analogy, you are taking out water from the well. So water is going out, right? And what? Drawings is receiving. So now in this case now, you are going to now in this case now, in this particular case, we're talking about money. So now think about it, a well filled with 1 million naira, right? So I'm using my fetching field to draw out 300,000. So what is going out? Cash is going out, and drawings account is receiving. So what? You are debiting the drawings account and you are crediting the cash account. Do you understand? So you are debiting the drawings account and you are crediting the cash account because what in this case now, cash is going out of the capital. Drawings is what's receiving. So I said this in this particular case, I said this is the portion of capital that is withdrawn from the business. Think of it like a bank account. Imagine you set aside 100,000 naira capital to invest in your company, but an urgent need came up and you have to take 20,000 naira out of the 100k. The 20k is called the drawings. It's called the drawings. It's the drawings. You understand? So now in this case now, think of it as a well of so one thing about accounting is that if you want to really, really understand this, because double entry can be very, very confusing, especially when you get to complex double entry, that you have probably you're debiting, you have to debit A, credit B, then debit C, credit B, just for one transaction. Or you can have like 4 or 5 different transactions, different debit, credit, and all of that. So when you get to complex transactions, it can be very, very confusing. So that's why I'm this foundational video. I'm trying to make you understand that if you want to understand accounting properly and actually thrive when it comes to using double entry, you have to visualize. You have to be an imaginative person. You understand? So drawings, think of it. Oh, I have a well filled with 100,000 naira, and an urgent need came, and I need 20,000 naira. So what do? I take a fetching bill. I draw out 20,000 naira. So what's happening? Cash is going out. So what? No, no, whatever is going out, you are what? You are crediting. Credit cash first, 20,000 naira. What is going in? Drawings is receiving. Abi? Drawings is receiving. So I'm debiting drawings. So then that's how you have it here. So you debit drawings and what you credit cash. So you debit drawings and you credit cash. Or bank. It could be from your bank account, it could be from your cash, your purse, or your wallet or something. So you credit your cash on the bank because that's what's going out, and you debit drawings. So cash is withdrawn from the business. So we credit cash if it was withdrawn from the bank balance. That's to say credit cash or bank. That's if it depends on where you're withdrawing the money from. It could be from your purse, your wallet, or your bank account. And then what do we do to the other item? We call the principle of double entry. We debit drawing. So remember the principle of double entry. For every debit entry, there must be a corresponding credit entry and vice versa. Vice versa basically means that now this is what it's just saying. For every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. So two must align. They are working together. They are working together. So now we have credited cash. We credited cash because cash is going at 20,000 naira, right? So we have to what? We have to debit drawings 20,000 naira. So that's just basically about drawings. So we debit drawings, see drawings, even though you're not sure of the other leg, just know that drawings is receiving. You understand? Drawings account is receiving. So you debit the drawings account. So another thing you debit again is the asset. The assets in accounting, we have two types of assets. We have the fixed assets and the current assets. Well, this is not the class for that. I'm still going to actually look at all of these things one by one, all these items one by one, but just for the purpose of understanding, your fixed assets are assets that you use for more than 1 year, while your current assets are assets that you use within a particular year. So fixed assets like non-current assets. That's the name they call it now, non-current assets. And the fixed assets, we have the assets of the company basically include your land, your building, your equipment, your machineries, your motor vans, your inventory, which is now called stock, and all of that. So you understand? So basically that's your assets. Those are your assets, basically. Those are your assets. It all consists or comprises of your assets. So we're going to be looking at all those things one by one in our subsequent classes, but this is just basically just for you to understand. So assets are like land, building, machineries, equipment, inventories, and all of that, motor vans. So now assets are to be debited. Now I bought a car, I bought a G wagon, I bought a Benz of 10 million naira, right? So what's happening now? We have two things: Benz account, which is the car, or let's say the motor car account, or the motor van account, or the car account, right? And we have what the cash account. So now I bought motor van 10 million naira. So now what's happening now? Cash is leaving my hand. I mean now, cash is leaving my hand. I'm actually taking out cash and giving it to the assets. Do you understand? So now the cash is going out, but the asset is receiving. Do you get? So what's happening to cash? And what do we do? What is going out? We credit it, right? So now we're crediting cash and we are debiting assets. So that's why assets usually have a what? Assets have a debit balance. Assets have debit balances. Assets have debit balances. So you get. So this is an oversight. So this should be yes. So let me even ask, what do you think is wrong with this? Before I even correct it, what do you think is wrong? Is this correct or wrong? Definitely, it is wrong. Why? Now that was just a test. This is wrong. Why? Because what? You are asset is what? Asset is not giving out. Asset is coming in, right? And what is going out? Cash is going out. So that's good. So clap for yourself. I'm happy if you got that. If you got that trick or that assessment, that little assessment that we did. So that's good. So that shows that you're following. And if you don't know why, for those that thought it was correct, let me actually say the reason why it's not correct. Now, asset, like I said earlier, asset is receiving. We are receiving an asset, right? But we are giving out cash. I remember they are giving now when you're giving an elderly person something, what we use the what your right hand. And what is the right hand side of our account? The credit side. So we are crediting cash because cash is going out. We are giving out cash. And we are what? We are receiving assets. So that's why we are what? We are debiting assets. I hope that's clear. If you have any question, just use the comment section, ask your questions. I will answer all your questions. So we receive an asset, so we received an asset, so we debited the asset and we gave out cash or transferred money to the vendor from our bank balance. It could be cash, it could be bank. So we credit cash. So that's the reason why assets is debited. That's the reason why assets have debited balances, basically debit balances. The next one is what? The next, we have date. We have talked about date, D. I've talked about the A. Now I want to talk about the second D, which is what? The debtors. Now, like I said earlier, the debtors are now called, the new name for debtors, according to the new standard, is what? Your trade receivables. That's the new name for debtors. That's your trade receivables. So it's no more called debtors again. It has been changed to trade receivables. You understand? So that's the new name for debtors. So, and who are debtors? Debtors are those that you're owing money. Your debtors, like you're owing debts, your palava people, your wahala people, or the people that are chasing you up and down to collect money, the people you're owing, basically, the person's, sorry, the people that are owing you, rather. Yes. So let's take that again. So who are your debtors? The debtors are those that are your own. Let me not use Yoruba here. Let's just be English. The debtors are what? The people that you are owing. The people that are owing you. Oh God. That's like it's tricky, right? But let's take that again. The debtors are the people that are owing you or owing your company. The persons owing your company. Like now, my debtors. My debtors. We do this often, even in families. You be like, oh, my sister asked for 5,000 naira the other day, or my brother asked for 5,000 naira, or my uncle, my auntie. Yeah, so you do this a lot. They say, oh, you're owing me, you're owing me, you're owing me, your friend. So those are your debtors. So those that are owing you, those that are owing your company, your people that you have to chase about asking for your money. So those are your debtors. Sorry. I think we're clear with that, right? That was just you understand. It can get a lot of a bit confusing sometimes, but don't worry, that's why we are here together. So the debtors are what? Those that are owing you, those that are indebted to you, those that are holding your probably money or as the case may be, those that are holding something valuable to you that are yet to return it or are yet to pay for it or something like that. Again, so we have two items now. We have the what? The debtors. The debtors. So now in a company, what are we doing? We are selling, we are buying and selling in the company. So now let's say I'm selling, like I said, I have a baking business, right? So I'm selling bake like okay, let's just stick to a particular product. I'm selling bread. I'm selling bread, right? I'm selling bread. So now if Mr. Ali comes to my shop and he comes to buy bread and says, oh, I want this particular bread, but I don't have cash now. I'll give you the cash tomorrow. And I give him the bread. So what's happening now? I've sold bread, but then I've not received money. So now, sales and the new name for sales is revenue. So that's what we have here. The new name for sales is revenue. Revenue is the new name for sales. So I've given out, I've sold. So you understand? So revenue sales as credit balance because you are giving out. When you are selling, you are giving out. Obviously, if I'm selling bread, I'm not carrying the bread and putting it in my bag. I'm giving it out to whoever is asking for the bread, right? So sales is has credit balances because I'm giving out when I'm selling, but I'm supposed to receive cash But in this particular case, the person said, "Oh, I don't have money now. I'll give you money tomorrow. Sorry, I don't have money now." He's even using, um, he's not even, he's not even saying sorry. He's just even not even apologetic about it. He's just, "Please, I don't have money. I'll give you money tomorrow." I said, "Okay, no problem. Take the bread. I want to sell. If the bread is there, to spoil." So what? I give him what? So I've sold bread. So I'm crediting bread. But rather than receiving money, I'm receiving a debtor. Someone that refused to pay me my money. So I have to open an account for him. So I'm receiving debtors. And debtors is also called what? The name for debtors is what? Trade receivable. So I'll open a trade receivables account and I received a trade receivable, or I received a debtor. And then what I gave out, I sold. So that's why we are debiting trade receivables because we received a debtor. A debtor just came, but then we gave out, we sold. So instead of cash, we received debtor. So that's why we are debiting debtors, which is now called trade receivables. And what we are crediting our revenue, which is also called sales. So in simple terms, like I said, we have two types of customers: the cash customers and the debt customers. So there are some that will actually give you cash. There are some that will give you that will not give you cash. So paraventure, let's imagine that Mr. Ali actually gave me cash. So what I'll do, what I'll credit sales because I'm giving out sales. And I'll do what? I will debit cash because I'm receiving cash. But in this case, he didn't give me cash. That's why I'm debiting trade receivables, which is also called debtors. Right? So the cash customers immediately. Those are the ones that will pay immediately. But the debt customers are the ones that will not pay immediately. The cash customers are those that pay immediately. But the debt customers are those that will buy on credit. Pay now, buy now, pay later, like Mr. Ali did. So the trade receivables receive goods. So we debit the account. You understand? So we received trade receivables and what we credit revenue. So the next one that we debit is what the expenses. So we have looked at DAD, we have looked at D, we have looked at A, we have looked at the second D. Now we want to look at the E, which is what the expenses. So expenses are like outflows. They are outflows in the company, right? The outflows that we use to generate and we generate outflows. So now an expense. Okay, I was giving examples here. Expenses include salary expenses, rental expenses, electricity. There are so many expenses. They are unending. They are unending actually. So in my baking company now, I'm doing a baking business, right? So in my baking company, I would obviously have probably pay rent. I would need electricity because I need my mixer to be running. I need my oven to be on. I need some other things, right? So I'll pay electricity. So let's just say rent and electricity. Those are my expenses that I'm incurring, right? So now expenses. Now I paid rent of 100,000 naira, 100,000 naira rent. So what's happening now? Cash is going out, but what rent is receiving. I don't know if you get expenses. We received the expense, but we gave out cash. We received the expenses, but we paid cash. So what's going to cash? Cash is going out. And what do we do to items going out? We credit it, right? So that's why we are crediting cash and we are debiting expenses. We are crediting cash and we are debiting expenses. I think it's clear, right? And if you have any question, just let me know in the comment section and I'll answer you. All right, so the next one is what? Creditors. We have the creditors. So now we're looking at the credit side. We're looking at the credit side rather. I think that we said the credit side, we have the what? Please. That's what we have for the credit side. So now let's not take one after the other. So the credit side, now we're done with we're done with the debit side now. Note that not only the drawings, assets, debtors and expense are to be debited. There are other items. There are so many items, but we're just going to be sticking with that basically for this part. But it's just all encompassing basically, so you know those items are listed are they cover a lot of things, so you just know. So, but then there are other things as we go on in our classes, subsequent classes, we still be talking about them, especially when we get to like complex issues or complex situations. But let's just stick to those four for now. Then this ones to creditors too. This credit and other things you can credit, but let's just stick to this for now. So that the first thing you credit your creditors. Your creditors are your suppliers. You know, we said earlier that debtors are those that are owing you. Now you are the king when it comes to debtors. They are like your servants in that sense. But them they are owing you. You're sitting on the throne, and then they are owing you. But now creditors is reverse is the case. Now somebody else sitting on the throne. Why you are the one that is owing the person in that sense. You get so creditors are the persons that the business is owned that you are owing. They are persons that you are owing. Do you understand? There are people that you are owing. And just as we have those owing us, we also have those whom we bought goods on credit from. So we have those that we are owing, and we have those that are owing us. You understand? It's like a circle. And the new name for stock is inventory. So now inventory, why I mentioned this, that now we used to call stock, but then it's not more stock again, it's now called inventory. So the creditors are those that we collect inventory from, but we don't pay. The debtors are those that they collect inventory from us, but they don't pay. So the debtors are those we that they collected inventory, we sold to them, but they have not yet paid, right? But then the creditors are those that sold to us, but we have not paid. It's just like an ideology. So just as you are a king somewhere, you are also a servant somewhere. So don't come down from your high horse, as they always say, because even as you are saying, "Oh, I'm a servant to this person. I'm a king to this person." You might also likely be a servant to another person. I'm just trying to use servant master relationship so that you can understand. Do you get? So now, what do we do? What do we do? Now we receive. We purchased. Now I need flour, I need sugar, I need butter, I need milk for my baking business, right? So I have to purchase all of that. So I purchased flour worth 50,000 naira from Mr. Ali. Do you understand? Or let's use another name. Since I use Mr. Ali for our debtors, let's use Mrs. Josephina. Mrs. Josephina. So I bought flour, 50,000 naira from, I purchased flour, 50,000 naira from Mrs. Josephina. Do you understand? So now I received flour. That means what? I received my purchase, right? So I'm debiting purchase. But now my creditors, I'm supposed to pay them cash, right? Mrs. Josephine, I'm supposed to pay her cash. But instead of paying her cash, I said, yeah, collect receivables and collect payables, trade payables. Now, and the new name for creditors is what? Trade payables. Don't forget. The new name. So when I'm talking about what's trade payables? Or trade payables is your creditors, right? Your suppliers. And your creditors is also your suppliers. So when I'm saying trade payables, know that I'm talking about your suppliers, your creditors. That's the new name. So now I received purchase from Mrs. Josephina, but I'm supposed to pay her with cash. But then instead I paid her. I didn't pay her. I'm owing her. So what I'll do I'll debit my purchases, and I'll do I'll credit my payables. So that's just basically why trade payables is credited. That's why your creditors are credited. So creditors actually have credit balances. Credit your creditors. Basically, they have credit balances because you will have received purchase. And don't forget the principle of double entry. Now you have debited purchases. What happens to the other side? Credit it, right? So even if you don't know what the second side should be, once you know one side, you're good to go. Basically, get so we receive inventory, we debit it. What happens to the other leg? According to double entry principle, we credit the payable. So that's why payables is credited. So the next thing is your liabilities. Now, liabilities are what? The present obligations of the business. The present obligations of the business that they must fulfill, that they have not yet done. They have liability, right? So in simple terms, pending outflows that have not yet been sorted. Like pending, like I'm supposed to pay A, I'm supposed to pay B, I'm supposed to pay C, I'm supposed to pay D, I'm supposed to pay a lot of people. I borrowed money, I've not paid my tax, I've had so much outstanding tax, I've not paid. So all those pending outflows, I've not yet paid them. It's not as if I have money, but I don't have time to pay them, right? So I've not yet paid them. But then pending outflows are like my liabilities. And a very good example is a loan. Loan is a very good example of a pending outflow. It's a loan. You understand? When you borrow money, you go to bank, borrow money, or you go to all these loan sharks, you borrow money. So you collect now to pay later. So what do you do now? Now you collect now to pay later. You collected cash from First Bank, but you have not paid them. So you received cash. So you debit your cash, or you could have received it in your bank account, right? So you debit your cash or credit your bank because you received cash. But now you are crediting loan, which is the second leg, according to principle of double entry. So that's why, and loan is just an example of a liability. We have different type of liabilities. So I just use loan as an example. So you are receiving cash, bank, receiving whatever from that person, and then you are crediting the loan or crediting the liability, just according to the principle of double entry. Now, like I said, even once you know one leg, you know the other. Because once you know that one leg is to be debited or credited, you know that the other leg is to be debited or credited. You understand? So once debited cash at bank, so the other leg is to be credited. So what we credit our loan physically. And don't forget, loan is just a type of liability. We have various types of liability. So the next one we have is our income, right? So incomes are basically the money received in the business. The money received in the business. So incomes are divided into revenue and gain. Yes, incomes cover revenue, incomes cover gain. Yes, and income is just basically all the money you receive in your business. So we have rental income, we have dividend received, we have a lot of incomes, so many, so many incomes. And like I said, the revenue, the income comprise of the revenue and the gain, includes revenue and gain. So revenue and gain make up the income. So if you have something like this, income is equals to revenue plus gain. So basically, something like that to get. So what is revenue? What is gain? We're going to look at that one after the other now. So revenue is basically all the inflows generated from the core activities. All the inflows generated from the core. What do we mean by that? I'm doing baking. I'm still using that example that we used earlier so that we just follow that pattern. I'm into baking, right? So any inflow from my baking, and like I said, I'm selling bread. I'm selling different type of breads. I'm selling normal bread. I'm selling coconut bread. I'm selling fruit bread. I'm selling so many types of bread, different varieties of bread. So the revenue I get or the inflows that I generate from normal bread, like just fluffy bread, revenues I or inflows I generate from fruit bread, from cake bread, from anything bread, from anything baking. That's my core activity. My core activity, my major thing I'm doing is what my primary activity, which my core activity is bread, is baking. So any inflow I receive from baking is called revenue. So revenues are inflows from core activities. Like now, like I said, for example, if the company sells bread, the inflow from bread is the revenue. Is the revenue. Now, gain is all the inflows from non-core activities. From non-core activities. Non-core activities. You get non-core activities. Like now, if I'm doing bread, but I said, okay, somebody just said, come and invest in First Bank or come and buy First Bank shares. And obviously, if I buy First Bank shares, I would get dividend. So now that dividend now is not, am I into a dividend receipt? No, dividend is just like a side hustle. Oh, instead of me to just leave my money here, I want to invest it in this business and I'm getting returns. So that returns is an inflow too, but then it's not for my core activity. So an example of an example of a gain is what? Investment. Investment. So inflows you get from investment are called gain. Inflows you get from investment are called gain. Do you understand? Or inflows you get from non-core activities, what is outside the scope of the business or outside the normal day-to-day activities of the business is a gain. But then inflows that you get from normal activities is what is the revenue. So in our subsequent class, we're going to be talking about this in total, but then let's just stick to this particular one for now. So now the income is made up of the revenue and the gain. I remember when we talked about revenue earlier, that we said revenue is okay. We're not talking about revenue, we'll talk about this later on. But let me just say this now. Revenue is what? Revenue is also called sales. Like the former name for revenue was sales, but now it's not called sales, it's now called revenue, right? So now revenue is to be credited. So if we're saying that we're crediting incomes and we are saying that incomes is what revenue plus gain, right? So that means income, that means revenue will be credited, gain will be credited. I don't know if you get what I'm saying. Do you get? So now income is equals to revenue and gain. So if we are crediting income, definitely we are going to credit revenue, we are going to credit gain. So it's just like killing one bird with one stone, like killing two birds with one stone, rather. Killing two birds with one stone. So if you forget, oh, am I supposed to credit income? Am I supposed to credit incomes? Oh, revenue is a branch under income or a baby under income. So if I'm crediting revenue, I'm definitely crediting incomes. So if you forget one, you can use one to remember another. Simple, right? Interesting, right? Wow. Wow, right? So now, incomes. Now, when you receive incomes, you has come. You know, you bought bread the other time, you did not pay me my money. Finally, he has come. He has decided to pay me my money. So what? I will receive incomes. You understand? I received, or let's say my dividend from First Bank, they finally paid me my dividend. So now I received cash, or they put it in my bank account. Let's just say cash. I received cash dividend as cash. And what I then the income, what happens to the other? And no, dividend is an income. So what happens to the other leg? I will credit it. Because now, don't forget the principle of double entry. For every credit entry, there must be the corresponding debit entry. And for every debit entry, there must be a corresponding credit entry. So if you're asking, why are we, since we're already debited cash, why are we crediting income again? Principle of double entry says that there must be double, double, twice. You must do it twice. So now, if we are debiting, we know we are debiting cash. What will happen to the other one? Right? We are crediting the other one, which is the one, which is the income, basically. I don't know if you have any question, just let me know in the comment section. It's very, very interesting. You understand? Very sweet. So that's why I said, in addition, if you credit incomes, then revenue will definitely have a credit balance. So if you forget one, you can use one to remember another. So it's very, very interesting, right? So now the next one is what the E. The equity now, E is called equity. Equity was formerly called capital. It was capital before, but now it's equity. And what is equity? Equity is the money used to start a business, right? Your capital is money used to start a business. And like we know the normal basic definition now, the money invested into your business. So now I have a shareholder. I'm doing my baking business. I'm still using that example. I'm doing my baking business. I'm Sally comes and say, I've actually been buying. Sally comes. He says, I've been buying a lot of things from you recently, and I just want to actually invest in this business. The day I came, the day I actually did not want to pay money, you allowed me to take the bread. I saw that you're a good person. I want to invest in your business. Wow. Oh, Mr. Lee, thank you very much for investing in our business. So what will you do? You give me cash, you give me money, right? So Mr. Lee says, oh, I want to invest 10 million naira into your business. Wow, that's nice. So I will receive cash, or probably paid it into my bank account. I'll receive it in my bank account or receive cash, as the case may be. And what will happen to the second leg according to the principle of double entry, which is what equity? I receive equity, right? So I will credit equity, which is also called capital. The former name was capital. So that's why you see that when you have equity, what do? You what? You debit equity, you debit cash rather, because you receive cash or bank. So let's just stick to cash. You debit cash and you credit equity. Very simple, right? Very, very simple. According to the principle of double entry. That's just basically what we do for equity. Now, the next one we have is the revenue. The revenue was also called sales, right? No, it's sales. Let's use sales because our acronym says S. So let's just use the word. So sales, like I said, revenue was formerly called sales. So the new name is revenue. You understand? The new name is, so you hear me say revenue, revenue. What's revenue? Sales, basically. So sales is the inflow generated from the core activity of the business. I've explained that before, from the major thing that we're doing. So why is it credited? I think I've talked about this a bit, but let's just talk about it again. So now, Mr. Ali came, he bought goods from me. He bought bread and gave me cash. So what have I done to cash? I've debited cash because I received cash. But what will happen to the second leg? I will credit it, which is what revenue. But if Mr. Ali came, he did not pay money, what will I do? I would debit trade receivables, which is debtor, because it's my debtor. He not pay me money. So instead of cash, he gave me debtor. He gave me receivables. So debit my cash, my or if he paid cash, and if he does not pay cash, if it was on credit, I will debit my what? My debtors. And what would I do to the second leg? I will credit my revenue. So that's the reason why revenue is credited in that case. You understand? So I gave an example of cash sales and credit sales. So I've talked about all this earlier, but if you have any questions, just let me know in the comment section. Let me know in the comment section. So I think that's all for today. So in summary, principle of double entry just states that for every debit entry, there must be a corresponding credit entry and vice versa. And we have acronyms, which we said, oh, we debit dates and credit please, and we explain all of that one by one. So this was an amazing class. I hope you actually enjoyed watching this video as much as I enjoyed recording it. If you didn't learn a lot, please, if you learned a lot, please hit the subscribe button, like my video, comment. If you have any questions, just let me know in the comment section. And then share this video to every and anyone that you know will benefit from it. So in our next class, we're going to be looking at practical examples. So just stick around, turn on your notification bell. I'm going to be giving you practical examples. We're going to be looking at practical examples, visual, like I'm going to be visual examples basically. And in subsequent classes, we'll be looking at other further aspects of basic accounting. So thank you so much for watching this video. Till we meet in our next class. Have a lovely day. Bye.